Cal, if you wouldn't mind, explain a little bit about the fact that when it comes to a job transition or just a transition period, certain things that people need to consider as it relates to their homes, for instance.
Yeah, there's a lot that can be said about that. And I do want to address one of the things that you mentioned too about the foreclosures, because we're quite aware of the market here as well as in the state of Ohio. And many people are not aware that there are programs to assist in that. For an example, there are many state programs that will provide funds for people who are delinquent on a mortgage or the real estate taxes or whatever vehicle is creating a foreclosure situation. Also, you don't want to wait, as Brent mentioned earlier, people wait too late before they do something. If you see it coming, don't wait till you're 4 or 5 months behind in the mortgage to decide to do something about it. If you see it coming, that's the time to go and address it. Speak to someone who's knowledgeable about how to assist in that situation. You don't want to wait till your credit's already bad to decide to refinance, for an example. A lot of the programs that have caused the foreclosures too, and there's many, I don't have time to go through it all, but a lot of people are in adjustable rate mortgages. What's going on is the adjustable rate mortgage is getting ready to mature, where the fixed period is over and now the rate and the payment's going to go up. And because the market is in a downswing right now, they go to look at a refinance, and because of the foreclosures, the values have gone down, and they're not in a position to refinance. And so what do? They can't refinance. The payment's going to go up. They can't afford it. What do people do? They walk. If they had planned well in advance for that situation, in many cases, there are things that can be done, so they should consult someone. And from a different perspective, too, a lot of people waste I will put it this way, that they don't position the house that they have, which is the biggest asset most people will purchase in a lifetime, in a way that benefits them. For an example.
Yeah, I was going to ask, could you elaborate on that a little bit?
Well, from a tax perspective, for an example, most people are in a position where they get a tax refund each year. And largely, if they own a home, it's because of the interest that they claim. And so they may get a $5,000 or $6,000 or $7,000, I've seen, tax refund at the end of the year, which simply represents that they're overpaying that amount in taxes each year.
Yeah, but a lot of people tend to want to say, well, I'd rather just, have Uncle Sam manage my money, or not so much manage my money. I'm afraid that I'll owe, and I don't want to owe.
Well, the misconception really is that when I get a tax refund that the government gave me something. And in fact, they did. They gave you back the money that you over deposited in the tax account, in the tax bank during the year, which is not really a bank because it's the worst savings account in the world. They don't pay you interest on that. So if a person is overpaying $6,000, or they're going to get a refund in that amount, then in essence they're overpaying their taxes at the rate of $500 a month. You're not obligated to do that. A good tax accountant can project that ahead of time. And
so pre-planning again.
Pre-planning.
Okay.
Can project ahead of time what that refund is going to be. And if I'm overpaying $500 a month, then I cannot pay that much extra each month. Well, that goes into my cash flow. That's managing my funds. If anything, I would rather utilize that $500. Let's grow up. The tax refund is not a gift for me to go blow year to year if I'm buying a house and raising a family. I should utilize that money to protect myself, or if I simply deposit it in a savings account, at least I have it available to me in cases of emergencies, and at least I'm earning interest on that money.
That's a good point.
Just to interject something there, I did an analysis for a client a while back, and when we looked at the difference of taking that $5,000 or $6,000 and giving it to Uncle Sam versus putting it into account, even though he blew it, after he got it back, we just earned interest on that, and then calculated that over the 20 years, even though he spent the refund every year. It was a $40,000 difference on letting the interest grow and spending that.
See, and I don't think people like I said, I've been in this doing 20 years, and it took me years before I finally realized this, okay?
Opportunities lost is really what it is.
And once it's gone, isn't it?
That's exactly right.
The thing that is important with regard to having people understand at least that concept of opportunity, okay, what they could have had,
Right.
what and how that affects them is really dramatic. And I think it's important for people to sit down and a lot of people have planners, okay, and whoever the planner is, you know, people are comfortable with and they're doing a good job. But at the same time, really take that with a lot of different areas, okay, and if you add those together, I mean, one of the things that you guys have talked about before that we haven't mentioned in terms of what we call wealth transfers, where you're giving away money unknowingly or unnecessarily because you just don't know how various systems, programs, institutions work.
Right.
And to have a planner that can help you recapture that could be significant, okay? In fact, could you kind of even talk about that? Because I know that's
Sure.
something that you spend a lot of time working with your clients about in terms of
Right.
just really understanding what wealth transfers are.
Right. Well, wealth transfers are where we have, the example is the tax, where we actually let Uncle Sam keep the money. If we actually invest that money, even in an interest-bearing account instead of the non-interest-bearing account the government has, if we take that for 1 year, $5,000 at 5%, you're looking at $250 that you wouldn't have had otherwise.
Right, right.
That is an opportunity cost, just interest. And if we multiply that over 20 years, that $250, even if we blow the 5,000, that 250 becomes 500 plus interest the next year.
Right.
And then 750 the next year plus interest. And all of a sudden we're at 1,000 and 2 and 3 and 5. And that's an opportunity cost. That is a wealth transfer because we gave the money to the government. The government is making money on that somewhere.
Somewhere, somehow.
They're doing something with it.
Right.
You're losing the opportunity. That's a wealth transfer. You gave them the opportunity with your money. That's what a wealth transfer really is. And that happens repeatedly because people will go to an insurance agent. Then they'll go to a stockbroker. And then they'll go to a mortgage person. And then they'll go to their accountant. And all of those plans will be done separately. And that oftentimes is the real bane in my practice, where I try to show people, if you work with a CPA, you work with your mortgage person, you work with a realtor, you work with the insurance folks, you bring them all together under one roof and have a common plan for the client, then we eliminate a lot of those wealth transfers, and that's really important.
Right. Well, I know one of the things, even with this whole program, that we're really emphasizing, you know, and kind of my role with my company, Talib Business Development and Financial Services, is that we like to be a liaison, if you will. In fact, that's kind of what I am, is a liaison to professionals and part of a network of professionals that really can help coordinate a lot of this for people.